Double the trouble, double the opportunity. It all started in 1494 with Luca Pacioli, an Italian monk and the father of accounting. Legend says he was inspired by a falling olive and, in a moment of brilliance, invented double-entry bookkeeping. This ingenious system, where each entry is balanced by an opposite entry, debits and credits, created the framework that still keeps accountants, businesses, and tax code opportunities in line today. If your credits don't balance with your debits, you know there's a glitch. And it's this balancing act that supports financial planning for tax savings and keeps potential tax issues in check. Double-entry bookkeeping has ruled accounting for over 500 years. We see it everywhere today, including in our tax code. For example, revenue flows in, balanced by expenses flowing out. Anything left over eventually winds up in the taxable income account. But here's the twist. Sometimes those balances open doors for IRS tax breaks and tax deduction strategies. For instance, real estate tax deductions allow investors to leverage depreciation tax savings to lower their tax burdens. Using cost segregation, we can help speed up those benefits. Normally, the IRS expects depreciation deductions to be recaptured as income when you sell. But savvy strategies like tax-free exchanges and stepped-up basis mean those depreciation benefits might never be recaptured, preserving your tax savings long-term. Now it's Halloween, America's second favorite holiday and a $12 billion industry this year. The National Retail Federation reports we'll spend over $100 per family, totaling $12 billion, including $3.8 billion on costumes, $3.8 billion on decorations, including everyone's favorite 12-foot skeleton from Home Depot, $3.5 billion on candy, and $500 million on greeting cards. Fun fact, Halloween candy is cheapest, exactly 4 days before the 31st. How does all that fit into Luca Pacioli's neat little boxes? Well, it gets scary the minute the greedy little trick-or-treater on the other side of your door goes running down your sidewalk with their loot. Here's the disconnect. The candy company sells sweets to a retailer. That's a taxable transaction. The retailer sells them to you. That's another taxable transaction. But then you just give the sugary treasures to the amped-up little goblins, pirates, and princesses on your porch. No deduction for you, no income for them, and no 1099s for the IRS. Can you imagine the 1099s? That removes everything from the IRS's world of debits and credits. Seriously, if the IRS taxed kids on their Halloween candy, they could collect enough to cover free dental care for everyone. If we look at Halloween from an accounting angle, it's all about managing wasting assets. Your kids stagger home with bulging bags of candy and dreams of sugar highs lasting until Thanksgiving. But pretty soon the good stuff is gone. No more Kit Kats, no more Snickers. They're left with a couple of fun-sized Milky Ways, some of those sad little Jolly Ranchers nobody really likes, and a few stale candy corns. At that point, you charge off the goodwill by throwing out the sticky dregs while they're at school and hoping the kids don't even notice. Today, your average accountant or tax professional focuses their effort on making sure the debits match the credits. It's scary how much they can leave on the table. That's why we don't stop with telling you how much you owe. We take the time to look for those tax disconnects to make your income disappear like your kids' candy. At Anvil Tax, we search for these disconnects in your tax profile that create tax code opportunities to save more and owe less. This Halloween, let's make those tax ghosts vanish. Contact Daveed Tuck, ex-IRS auditor and Portland financial consultant, for a strategy that'll sweeten your bottom line.